Okay, good morning to all of you. I think we have the numbers to start off the class. So yesterday we were discussing on the audit of the cash, okay, audit of cash. We went ahead and discussed the unique procedures that one of the unique procedure that we can use when it comes to the audit of cash, okay, was on the use of the bank confirmation, the use of the bank confirmation, okay, as well as the use of the cash count, okay, as well as the use of cash count. Maybe just to reiterate on the cash count, okay, we say that during the audit planning phase, okay, maybe just once you get appointed as the auditor, okay, of course you plan on how you do intend to approach the audit, okay. We did say that you have to consider, okay, when is the client going to do the cash count, okay. Then of course, once you do get that information, you do incorporation of that information in your audit planning memorandum, okay. So you need to incorporate that in your audit planning memorandum, okay. So if the client say that they're going to do the cash count on 1st of May, okay, you need to see, okay, how will I be able to avail myself, okay, during that cash count, okay. At the same time, don't forget to say that your main work, just like the case of the inventory count, okay, your main work is more or less to see that the process of the cash count, okay, is being done effectively, okay, not more or less like, more or less, your work is to see as to whether the cash count is being done effectively. Okay, your work is not to tell them what to do. Don't forget, this is a management activity. Okay, your main work as an auditor is to assess as to whether the process is being done effectively. To assess. Okay, you're not meant to be there to guide them. Tell them you're meant to do A, you're meant to do B. No. Okay, your work is to see as to whether the process is being done effectively. Okay, if not, then of course you need to take a note in your audit work files, in your audit work papers. Okay, you take a note of how the process was done and whether there could be chance the controls are not working, or maybe there could be statement, okay, on that particular cash account. Okay. Well, at the same time, okay, if, for example, okay, sometimes you can have a scenario where the cash actually, okay, is maybe, okay, if there's cash that has been mailed, okay, if there's cash that has been mailed by the customers of the company, okay, that can include also the case of checks, okay. I don't know whether it is possible for the physical cash, but in case that is going to be possible, okay, and it is unopened, okay, if that cash is not, if the mail in quote is not opened, okay, it is going to be open during the cash count, okay. Don't forget, you also have to ensure that the opening in quote is done in the presence of the representative of the client, okay. In short, you should not be in quote alone with the cash, okay. You should not be alone with the cash, okay. And I think we did say the main reason as to why this should be the case, okay. Just in case maybe someone stolen money, okay, they can use you as a scapegoat, okay. So you have to be quite careful, okay. Ensure that at any point in time, okay, when the cash count is being done, you are in the presence of a representative, okay, from the client, okay. The main reason is that you don't want to have a case where the client, someone tried to pass on the blame to you, okay, that you stole the cash, okay. So ensure as much as possible that you do it in the presence of the client, okay, in the presence of someone from the company that you are auditing, okay. Meet someone here. Okay, so that was more towards the cash count, okay, towards the cash count, okay. Don't forget, you don't need to maybe be available in every single location. If it is possible, okay, if the client has branches, I think we mentioned this, okay. If the client has multiple branches, then you may want to go to all those branches. But if it is not possible, don't forget, it is not a must in quote, okay. It is not like it's a must that you go to, you do attend, okay, all the cash count, okay. Then the cash count, okay, for those locations, no, for all the location, okay, whether you're going to be there through your employees as an auditor or you're going to be there physically, okay, don't forget it needs to be done at the same time. So all the branches, okay, all the different locations, okay, the cash count need to be done at the same time, okay, they need to be done at the same time, okay. That is the key you need to take note of, okay. All the cash count need to be done at the same time, okay. you can also carry out what we call a test count, okay? So you don't have to sort of like audit every single coin or every single check. You don't have to do that, okay? You can do what we call the test count. Just like in the case of the inventory, okay? You can do a test count, okay? You can do a test count, okay? That was the case of the audit of cash, okay? Now, just to make a mention on the audit of non-current liabilities, okay, so I will share this note later on, okay, I'll share this later on, okay. Okay, hope you can see my notes. On the audit of the non-current liability, okay. In this case, the non-current liability, we mean the case of the bonds, if the company has bonds, the case of debentures, okay, as well as we do have the long-term bank loans, okay, the long-term bank loans. So all these are part and parcel of what we mean by the non-current liability. The same thing we do, okay, just like the case we have been doing with the other accounts, okay. You have to begin by determining, okay, what are the financial statement assumptions, okay, what are the financial statement assumptions that I will be using, okay, what are the financial statement assumptions I will be using in the case of the non-current liability, okay. Don't forget this is a balance sheet account, okay, or these are balance sheet accounts, okay. Of course, completeness, on accuracy, okay, on does it require valuation? Not necessarily, because you're the one issuing, okay, so valuation might not be I don't think it's going to be such a huge assertion, okay, on the valuation. Does it require? I don't think it requires, okay. Maybe the other matter could be on cutoff. Actually, cutoff could be not cutoff. Could be a matter that you may want to consider, okay, as to, for example, on the payment of the interest, okay. So cutoff can be also an assertion that you may want to consider here, okay. On the payment of the interest, you may want to consider, okay. If the interest is paid in the month of January, then of course it need not to be reflected in the principal, okay. If the principal and the interest are paid after the period, okay, don't forget, we don't need to recognize. Now, if, for example, the interest is paid in the month of January, okay, in the month, the principal and the interest are paid in the month of January, okay, the company should not recognize them in the month of December, okay. So you want to ensure that the closing loan balance in the month of December, okay, ought to be reflecting what the company owes, for example, by the end of that 1st of December, okay. So if the principal is paid in the month of January, then it should not be reported in the month of, okay, December, okay. So that may be another assertion that you may want to consider, okay. For example, in the case of the cutoff, okay, the case of a cutoff, and of course, by implication, the financial statement assertion on accuracy, okay. So of course, you begin the assertion, okay, that you're going to be considering. Then down there, you discuss what procedures can I use in order to test each of those assertions, okay. On completeness, can do the following. On accuracy, can do the following. On the cutoff, can do the following. On the classification, can do the following, okay. On the matters of disclosure, these are the assertions, okay. They need to be, the users of the accounts need to understand what is happening quite well, okay. So all those are assertions that you may want to consider, okay? All those assertions that you may want to consider, okay? Now, what is the plan you can follow, okay? What is the plan that you can follow, okay? Now, don't forget, okay, the plan you can follow, yeah, your main intention is to assess as to whether the company reporting, okay, you want to assess as whether the way the company is reporting, okay, on the financial statement, the way the company is reporting on the non-current liability, okay, do tally with those financial statement assertion we have just mentioned above there, okay. If you remember, okay, when we were discussing the cash count, okay, on the case of the audit of cash, we did say that one of the procedure that you can use is the third-party confirmation. The third-party confirmation, okay, confirming from the bank, okay, on, for example, the cash balances. One of the items you will confirm, for example, is the outstanding loan balances, okay. It was on the outstanding loan balances, okay. In that case, therefore, you're going to be asking the bank, okay, at that 1st of December, okay, at that 1st of December, what is the amount of, what's the loan balance that my client still owes you, okay. So don't forget that is one of the key procedures you can follow actually, okay. that the use of the third-party confirmation, okay, that is from the letter, okay, or that you did, or the request you did send out to the bank. One of the matter you may want to be confirming is the outstanding loan balances, the outstanding loan balances, okay. I think we did mention all this, okay. So over and above that, what else can you do, okay? So obtain or prepare a schedule of loans, okay? So obtain it, okay? This can be from that party, okay? I think mention this, okay? You get this from that party, okay? Ask the bank, okay? Get to know when the loan was acquired, okay? Get to know what is the outstanding balance at this particular time period, okay? How much interest has the company paid over this particular time period, okay? Or in some cases, you may want to do your own, you prepare, okay, your loan amortization schedule, okay, which I think you did in finance, okay. So you can prepare, okay, your own loan amortization schedule. Okay, and of course you compare, for example, with what the client has prepared, okay. So you make a comparison as well to check on any potential misstatement, okay. So by preparing, for example, a loan amortization schedule, okay, that's kind of procedure you can carry out, okay. And the procedure you can carry out is, for example, you can compare open balances, okay, open balances to the previous year papers, okay. What does that mean? Essentially, okay, we would expect that over time, okay, the loan balance need to be decreasing, okay, the loan balance need to be decreasing, okay. Why? Because the company is paying, okay. If the company is paying the principal, then of course the balance need to be decreasing, okay. So by a simple comparison of last year balances and this year balances, okay, then from there we can construe, okay. From there we can go to the start, okay. This company, could it be not are the loan balances reported accurately, okay? Are the company loan balances being reported accurately, okay? Because we would expect, okay, we would expect that the loan balance is decreasing. If not, then of course you may want to inquire for the management as to why the loan balance is not decreasing, okay? Could there be a chance that maybe the company during the year did acquire more loans or did obtain more loans from the bank, for example, okay? By a simple comparison of the balances, okay? The simple comparison of the balances, okay? And actually, okay, when it comes to the loan, okay, we're going to discuss the next bit of our syllabus will be on what we call the going concern review, okay, so be a going concern review, okay. So if the company is always borrowing money, could it be that it cannot sustain its operation? If in future this debt provider, okay, if in future this debt provider will not, okay, or will withdraw, okay, the financing to the company, can the company survive? Can the company be able to survive? Okay, so you may want to assess, okay, from a going concern point of view, okay, from a going concern point of view, can the company be able to sustain its operation? Can the company be able to sustain operation? So in case the loan balance are not decreasing, if anything they are increasing, then that might be quite worrisome, okay, when it comes to the company going concern, okay. The procedure you can carry out is, for example, is test the clinical accuracy of the analysis, okay. You can do this by yourself preparing, okay, I think I mentioned the loan amortization schedule, okay. So you can do this by preparing a loan amortization schedule, okay. So yourself, you prepare that, okay. Let me try to see if I can. David, let me just, David. Yes, David. David?
Your notes are not clear from my side. They appear blurred.
Oh, this PDF is not so clear. Even now?
Yes.
Oh, okay.
Yeah, even now.
Even now, okay. Does this apply to all the others? Let me check. And this appears to all the others. Yeah, okay. Okay, just give me a minute. Just give me a minute. Give me a minute. I try to do something to them. How are they now? Check. So, David, how are they now?
They're still not as clear. I don't know whether it's from my side the problem is.
No, I see that it's you also. I think someone else has mentioned that it is not clear from from the head also. Okay. Again, I'm not sure what I should do. Karen, how is it from your head? Because Karen had mentioned that it wasn't clear from her head. How is it, Karen? It's Karen. Karen, is it clear now?
No.
It isn't clear. Wow. Okay. I'll share this note later alone because I'm not sure what else I can be able to do for now. Wow. And there are 2 slides. Okay, I think there are like 3 slides. So I hope I'll share with them later alone. So I hope that you can be able to go through them again. Okay. Okay. Okay, so I think we are saying compare the you test on the accuracy of the figures, okay, by yourself reperforming, okay, one of the procedure, okay, and on the procedure the client normally carries out, okay, is the use of the loan or preparing a loan amortization schedule. So you may want to prepare that yourself as well, so that you make a comparison. You can make a comparison, okay, of what the client has prepared, okay, versus what they ought to prepare. Then you can compare the figures, okay, in case there's any material difference, okay, if there's any material difference between the balance, okay, and then you can be able to inquire for the management, okay, as to why there is that difference, okay. Then also you can test on compare the balances to the GL, okay, definitely, because you want to ensure. Why do you want to compare? Okay, just to ensure that the client is representing, okay, on the face of the balance sheet, okay, the correct balance are being reported, okay, the correct balances are being reported, okay, by comparing what's in the GL, okay. Don't forget the final financial statement are extracted from the GL, okay, so they're extracted from the GL, okay. So compare, okay, what is the cash balance, what is the loan balance, okay, as per what you have calculated versus what the client has actually calculated versus what is appearing on the GL, on the final face of the financial statement, okay. Also, you can have a register of debentures, okay? You can have a register of debentures, and of course, you do need to agree, for example, the name of the lender, okay, who did provide the company with money. Why is it this simple? Why is it important to know who is the lender? Okay, because sometimes you can have cases, okay, where these loans are being provided, okay, are they grants, okay, because we have don't forget in cases, okay, that grants can also be provided, okay, and as per se, okay, they need to be disclosed well. So there's no way that you're going to obtain loans from a commercial bank, okay, and it is going to be classified as a grant. That can't happen, okay. It can be classified. It can't happen, okay. So of course, the grant is going to come, for example, okay, from either from the government, okay, or from in whatever context, okay, multinational agencies, but it's not going to come from a commercial bank, okay. So the main idea is where you may want to understand the name of the lender is more towards on the classification side, okay. It's more towards on how those non-current liabilities are being classified, okay. How are they being classified, okay. And so trace additions and repayments. And also maybe just to make a mention on that, agree the name of the lender, okay. If, for example, the loan came from a non-commercial entity, okay, in short, this is a grant, okay, the company has received from that non-commercial entity, okay, then of course the interest that is going to be charged, okay, or rather, you may have to consider that the interest that may be charged, if any, in the first place, okay, is going to be very minimal. It is also on non-commercial terms, okay. Don't forget, you can have cases where maybe, okay, the management may want to misuse, okay, in quotes, okay, misuse the grant received from those lenders, okay, from those lenders, okay, because essentially, don't forget, the grants generally have non-commercial terms, okay. They have more or less, in quotes, good terms compared to what the company can receive from the bank, okay. The bank can charge, for example, 50% interest per annum. The grant can be a minimum of 4%, okay. So there's no way that the interest on those grants, okay, should be comparing with the interest on the commercial loans, okay. That's what you need to understand. Okay, what type of loan? Who is the person who gave you this particular financing? Is it a grant? If it's a grant, then of course you have to compare. Okay, how much interest? What's the interest rate that is being charged on those grants versus on those commercial loans the company has obtained from the commercial banks? Okay, there need to be a difference. Okay, there need to be a difference. If that's not the case, then of course you may want to inquire from the management, okay, as to why the interest is higher than the loans they are obtained from the commercial companies, okay, from the commercial banks, okay. You can trace additions and repayment to entries in the cash book, okay. If the company is paying principal, if the company is paying the interest, of course, we would expect it is paying through the bank, okay. It is not being paid in form of cash, okay, even though that can happen. But in most cases, in most commercial cases, the payment is being made through the bank. So we need to see a hit on the bank statement of the company, okay. There need to be a hit of the payment that was made on those bank statements, okay. So trace those payments, trace those even addition in case the company has obtained extra loans, okay, on the face of the company balance sheet, okay. Yeah, the company applied for loan on the 1st of March, okay. It was received on 3rd of March, okay. We would expect that on that of March, we shall find a cash inflow in form of loans from the bank, okay. So you need to trace it, okay. Yeah, the company is saying that we did have this loan, okay. We did apply for this loan. We need to see the cash, okay. And how do you see that? By tracing that addition to the cash book. If their payments, the company says that we did pay an interest equal to X amount of money, then of course, if that interest payment, okay, need to also appear on the face of the bank statement, okay. So need to trace it to the bank statement, okay. Confirm repayments in accordance with the loan agreement, okay. Of course, every loan, okay, that the company is going to be taking, okay, because there'll be there will be legal contracts, okay, between the company and of course the providers of the loan, the bank, okay. So there will be sort of agreement between those two parties, okay. So as a company, okay, you as an auditor, okay, you may want to assess, okay, is the company in compliance with the agreement that they did enter into between the bank and your client, okay? Is the company fulfilling the terms and conditions, okay? Is the company fulfilling the terms and conditions they had on the loan agreement, okay? If the company is not fulfilling those terms, okay, if the company is not fulfilling those terms, okay, what will be the issue? Now, the issue here could be, okay, that maybe the company going concern might be jeopardized, because don't forget, the provider of the loan, okay, the loan provider, okay, they will have to consider, they will have to have, okay, one of the terms, okay, that the loan provider might have is that if you don't pay me the interest, for example, on the due date, okay, then I can declare you as sort of a bad loan, okay. And if that happens, then of course I can apply for you to be liquidated. Okay, and I think you've seen these cases. Okay, where the bank do liquidate assets of their borrowers. Okay, in order to recoup their loans. Okay. Now, if the repayment that the company is making is not in accordance with those loan agreements, what is the implication? What is the loan agreement saying if either the party do not fulfill the terms and conditions stated in the loan agreement? Okay, what happens? Okay, because one of the things that might happen, okay, is that the bank, okay, is meant to go and apply to the courts, okay, and ask for the company to be declared to be liquidated, okay, to be declared bankrupt, okay. Now, what does that mean regarding therefore the future of the company? Okay, again, that implies therefore a going concern issue. Okay, that implies therefore a going concern issue. Okay, So you as an auditor, you may want to confirm what the repayment has been, okay, and see whether they are in accordance with the loan agreement the company had with those providers of loans, okay. So this goes back more towards a going concern issue, okay, if the company does not pay, okay, as per what they had agreed with the bank, okay. Examine cancel checks and memoranda of subscription for loan repaid, okay. For example, the loans that have been repaid, okay, then you may want to, if there's some loans that have been fully paid, okay, if the loans that have been fully paid, okay, then of course we would expect that as a company, they should not be going forward, they ought not be making any further recognition of those loans in their books, okay, on those loans from their books, okay. If the company, if there was, if you remember, we did say about this cancelled checks, okay. If, for example, okay, if, for example, the company did prepare, okay, the company did write a check, okay, for payment of the interest payment of principal to the bank, and that check has been cancelled, then of course it also needs to be to appear, okay, more or less also on the end of the cash inflow, okay. So if now we'll time to use here, okay. If the company, if on the side, if the company do have they do have their cash book, okay, and they have written a check, okay, what's happening, okay, is that the check has been written in the company cash book as a cash outflow, okay. This is check that have been physically written. So if that's the case, okay, then of course that is going to appear as if it was a cash outflow in the company cash book, okay. If that check was cancelled, okay, don't forget it need therefore to be a reverse, okay. In quote is that it need to be a reversal, okay. There need to be a reversal entry in the company cash book, okay. So examine whether all those checks that have been cancelled, okay, the reversal entries, okay, have been made on the company cash book, okay. So we need to examine whether the company has actually gone ahead and done that, okay. Then another thing we consider is you need to consider, okay, on the loan agreement is as to whether the company has fulfilled all the terms and conditions of the loan agreement. One of the terms we mentioned was on the repayment, okay. As for the agreement, the company is meant to pay, for example, 1 million every year, okay, for the 5 million loan they took, okay, for example, okay. So that the company to adhere to that, okay. However, there are other terms and conditions, okay, on the debt covenants, okay. I think we did this in finance, okay, the debt covenants, okay. These are the terms and conditions. So consider as an auditor, okay, has a company fulfilled all the terms and conditions, okay. As a company, for example, okay, one of the terms and conditions could be that the company shall not pay shareholder any dividends, okay. That can be one of the agreements the company had with the loan provider, okay, that the company shall not pay any dividends for the next 3 years. Now, has a company paid the dividend? So consider, okay, you as an auditor, has a company, for example, paid dividends, okay, for the last 3 years as per the agreement, okay? If the company has paid the dividends against what was contained in the loan covenant, in the debt covenant, what's the implication, okay? If the other condition was that the company, okay, shall not exceed or shall not borrow more than $10 million, and now the company has borrowed an extra loan, which has increased the debt of the company from, let's say, 8 million to 11 million, what's the implication of that, of the increase in the loan balance over and above the agreed upon contracts between the company and the banks, okay? What's the implication? So verify the company has not exceeded. If the company has negated the terms and conditions of the loan agreement, what's the implication? Understand, okay? Get to understand what's the implication of the company over borrowing, okay, over and above the limit they are agreed with the loan providers, okay? Because it might have a going concern issue, okay? As I mentioned, the bank would have, in the contract, the bank would have foreseen some of this situation. They can see, for example, if you increase the balance above what you have agreed, okay, above 10 million, then you're going to fully pay us about 8 million. Okay, so that's the case, okay. Now, if the company has increased the limit to the 11 million, negating the 10 million agreed upon limit, then that means therefore the company need to pay the bank 8 million. Now, the next question is that can the company be able to pay the 8 million? Okay, will that mean that the company you have a going concern issue, okay? And you need to verify that the company, all the terms and conditions of the loan agreement, the company is fulfilling them. If not, what's the implication? Okay, you need to inquire from the management. Okay, if they have gone against the terms and conditions, what does it mean? Okay, if it means the company need to pay the loan, the entire loan of 8 million, can the company be able to pay that 8 million? Okay. Examine the signed board meetings relating to the new borrowings or repayments. Okay. Definitely, if this is an uncurrent liability, okay, is this not like working capital, okay, where the company is getting this an overdraft where we don't need the sanctioning of those charged governance. This is an uncurrent liability. So by default, it means therefore that those charged governance, they did approve that loan, okay, they did approve the loan. So you need, how do you know that there's approval? There must be some minutes on the board meetings that were discussing that loan the company want to acquire from, let's say from KCB. Okay, there must have been, that is for sure. Okay, the minutes of the board. The board must have discussed that we shall go ahead and finance these assets by borrowing, let's say 10 million from KCB. Okay, so examine whether there's authorization, okay, of those new borrowings. Okay, through examining the minutes of the board of the company. Okay. I think you may want to confirm, okay, from the banks. Okay, I think I did mention this. Okay, you may want to confirm from the bank, for example, the amount of loan outstanding at a point in time, the interest that was paid, the principal that was paid at that point in time, any security the company, the bank is holding, okay, for a loan, okay, that the company took from the bank. Okay, so this is third party information, which I think we have discussed in detail. Okay, we have discussed this in detail. Okay, and the bank confirmation. Okay, so here you're going to be as part of one of the matter you may want to discuss with, you may want to get from the bank. Okay, by writing a bank confirmation letter. Okay, I think we did discuss all this. Okay. You can also verify interest charge, okay, for the period in accordance with the statement and supporting agreements. Okay. So as mentioned, in most cases, okay, if they are commercial loans, okay, and of course in most cases they will be commercial loans, okay, not grants, okay, we would expect that the company do pay the interest, okay. These are commercial loans, so the interest is meant to be paid, okay. In that case, therefore, okay, you need to verify, okay, the interest charge, the period, and what is appearing on the statements, okay. I think I mentioned here, okay, let me just go back the slide before, okay. Yes, I think here it was obtain or prepare a schedule of loans, okay. So here in the loan amortization schedule, on the loan amortization schedule, okay, hope you have a mental picture of how you do prepare it, okay. One of the columns here, okay, will be the interest charge, okay, will be the interest charge, okay. Now from the interest charge there, okay, let me just, okay, share my notes here. No, Ashley, you can't hear me. No. No. Hey, how should I rotate the screen now? No, Ashley, can you hear me now? No, I'm trying. Let me just confirm who else. Ashley. Ashley.
Yes.
You can hear me?
Yes. Yes.
Okay. Let me see if there's another concern. Okay. So I was mentioning, okay, new share. Okay, maybe just to refresh your mind what you discussed, what you did in finance. But in the case of the loan, okay, the loan amortization schedule, okay, you're going to have here, for example, the period of the loan, you're going to have the loan balance outstanding, Okay, carry down. I'm going to have here, for example, the interest paid. Okay, so they're going to be in columns. Okay, so here you can have period 1, period 2, period 3. Okay, you can have, let's say, 1,000. That's what the interest paid. 900, 800. The sum total here, of course, for the end of the year, for example, okay, is going, for example, be 2,700. Okay, this is from the loan amortization you have prepared. Okay, when you see that this, you can confirm this with what the client has prepared. Okay, so you compare your schedule, the one you prepared as an auditor, versus what the client prepared. Okay, so compare how, for example, the interest has been charged. Okay, here your schedule. Okay, versus what the client did prepare. Okay. We are saying that this interest, don't forget, as soon as two balance they do tally, okay? The one prepared the client and one you have prepared, they do tally. Then of course, this is what need to appear on the GL, okay? This is what need to appear on the general ledger. Okay, this is what need to appear on the general ledger, okay? So simple that, okay? This need to appear on the GL, okay? So I was mentioning on a point here. So verify the second point, okay, verify interest charge for the period in accordance with statement and separate agreement, okay. So I think and be consistent with the interest rates, okay. The easiest way for you to do that is by you preparing, okay, that loan amortization schedule, okay. If the company has used some of their assets, okay, security, then of course they need to be in the register of charges, okay. If the company has used some of their assets, they need to be on the register of charges, okay. And of course, you as a client, you as the management, okay, provide me with a copy of register of charges that you did obtain from, okay, the registrar, okay. That's need to more or less going to appear, okay. Review the strict governance and provision dates to default, okay. If I think we mentioned this on the debt covenants, okay, you need to review, okay, if we need to review, okay, as to what are the terms and conditions of loan agreement, okay, especially those terms and conditions, okay, that do make a restriction on the company activities, okay, one of them being on the limit of the borrowings, okay, we can measure that, okay. Try to see, okay, has the company gone against the covenants, those restrictive covenants, okay, has the company gone against them, okay, and of course, what's the implication, okay, what's the implication, for example, of those covenants, okay. If the company has borrowed more than the 10 million limit they had set, okay, they have taken an extra 1 million, okay, they have taken an extra 3 million, okay. Now, what does it mean? What's the implication? Okay, try to understand. Okay, have a discussion with the management. Okay, if, for example, the amount, okay, has exceeded what was the set limit. Okay, if the agreement was the company need to not pay dividends, okay, for the next 3 years, and the company has paid the dividend, what's the implication? Need to understand. Okay, if there's a default, if some of the terms and conditions have not been fulfilled, those listed covenants have not been fulfilled. What's the implication? Okay. One of the implications, okay, I think you mentioned this, is that the company or the bank may ask the client, okay, to pay fully the amount of loan that they still owe the bank. Okay. That's one of the implications. Okay. The agreement was that you're not going to pay yourself in a dividend. You have gone ahead and paid yourself dividend. Then fully pay us the loan that is still remaining. Okay. If that is the implication, then can the company be able to afford paying the 8 million, okay, they owe the bank, for example, okay, can the company be able to pay, okay, what was the implication, okay, does it mean the company, if the company can't be able to pay, what does that mean? Is the bank going to apply for bankruptcy, okay, is the bank going to apply for the company liquidation? Okay, have a discussion with the management. If, for example, okay, upon reviewing those covenants, you do feel as if some of the terms and conditions have not been met by your client. Okay. Okay, you can also review the minutes. Cash book to confirm that all loans have been recorded. Okay, so review the board meetings. Okay, minutes of the board meetings. Okay, as mentioned, for all the non-current loans. Okay, for all the non-current loans, we would expect that they were approved. Okay, is a must, not that you expect. Okay, all those non-current loans were approved by the board. Okay, so review the minutes of the board, see as whether all those loans the bank has sanctioned. Okay, and they have matured. That is, they have obtained the money from the bank. They are being recorded as part of the loan balance outstanding by the end of the year. Okay. Review those accounts to ensure that all disclosure for the non-current liabilities have been fulfilled. Okay, so this is going to be the notes of the financial statement. Okay, the company has made adequate disclosure. The company has made adequate disclosure. Okay, regarding the loans or regarding the non-current liability they still owe. Okay. One of the things that might be the company may want to disclose, okay, could be in case the company during the year, okay, did obtain some further loans, okay. If the company during the year did obtain some further loans, okay, then you may or this need to be disclosed on the company non-current liability. If it knows the financial statement, there need to be such disclosure that during the year we did obtain $10 million of loan, okay. So they need to be that disclosure. Okay, the users need to understand the company is increasing its borrowing to finance A, to finance B, or to finance C. Okay. Another disclosure is the intention. Okay, maybe by the end of the year, okay, that 1st of December, the company has a potential project in the following year. Okay, that's the year 2021, for example. Okay, that they want to finance. They want to finance this project through a bank loan. Okay, so because maybe, okay, if for example the board has put that in mind, they have had a discussion, okay, then you may want to tell the users that going forward in the year 2021, we anticipate that we shall borrow money, okay, to finance this particular project. Okay, so all those need to be done on the notes, the financial statement. Okay, clear? Question? Okay, if there's no question, then I think more or less they can assume that that's going to cover what you've done so far were the audit of key assets, key accounts, not assets. Okay, key accounts. Okay, we have discussed audit of non-current assets, audit of current assets, inventory, cash, receivable, and now more or less audit of the non-current liabilities. Okay, so I think from there you have more or less a rough idea of that you can also extend on the audit of the current liabilities, the payables, okay, the accruals, okay. Yeah, and as I mentioned, don't forget key things that we simply going to start with a session, okay. You begin with a session in mind, okay. Then for each of the session, you can have a procedure, okay. Okay, this is how I would test this assertion. Okay, accuracy, I'll do A, B, C, and D. Completeness, I'll do this, and that. Okay, on classification, I'll do this, and that. Okay, so as I mentioned, these are free marks question. Okay, just get to start. Okay, how do you're going to go about it? Okay, simply need to start. What are the procedures? Okay, what are the assertion, and what procedures can I use to test that particular account? Okay. Then having done that, I guess that can mark there for the end of the substantive audit procedures. Okay, the end of the substantive audit procedures on those unique accounts, non-current assets, inventory, receivable, cash, as well as the case of the non-current liabilities. Okay, if it's clear, then I guess we can take a break. Then we come back and we discuss. Don't forget, once you've done the substantive audit procedure, don't forget, this is where most of your work is going to be. Under the substantive audit procedure, this is where you're going even to form the opinion. By the end of this step, okay, let me take it back to our audit, our audit cycle, okay. Don't forget here, this is where we are, okay. Okay, here was on the substantive procedure. Okay, once you've done this step, then you've done the bulk part of the audit. Okay, once you've done the step, you've done the bulk part of the audit. Okay, now what's the next step now? Is the review of financial statement. The next step, therefore, is the review of the audit finalization and review. Therefore, our next topic, therefore, is audit finalization and review. Okay, that's our next topic: audit finalization and review. Okay. Okay, I guess we'll take a break, then we come back. Okay. Okay, David, I've tried to readjust my screen resolution. I hope this does help. Okay, I hope it does help for sure. So, David, how is it? David, how is it?
It's better.
It's better. Okay. Okay. Okay, so our final, not our final. What's happening here? Okay. So our next topic is on audit review and finalization. Okay, audit review and finalization. In short, just before you give your final audit opinion, what do? Okay, we want to finalize now the audit process. Okay, now after that, now we can give the opinion. Okay, so therefore, main topic here is trying to assess. Okay, what do we do just before? Okay, once you've already done the substantive audit procedure. Okay, once you've carried out the substantive audit procedure on all the key accounts. Okay, the sales. Okay, I don't know, the purchases, the key expenses, the key non-current assets. Okay, if receivable, inventory, cash, or material. Okay. By the way, don't forget that you don't need to audit every single account. Okay, don't forget that by the way. Okay, that you're going to be auditing what is material. Don't forget, we apply the concept of materiality. If, for example, the payables is immaterial, you don't have to audit it. Okay? Apply the concept of materiality. Okay, don't forget even there. Okay. Anyway, once you've therefore done you've carried out the substantive audit procedure. You've carried out the substantive audit procedures, okay, on all those key accounts, on all those material accounts. Now, what do you do next, okay? But this is just before you give your opinion, okay? We need to call audit finalization and review. We need to call an audit review. Okay? And what does the audit review and finalization involve? It will involve, okay, what is the overall review of the evidence you obtain? Okay, over the course of the audit, okay, of course you have been obtaining the evidence. Okay, for example, in the case of motor vehicle, you are trying to assess that the company has the right to the receipt of any future economic benefit. Okay, so simply on there, where does the company own that motor vehicle? So what did you ask the management? What did you ask the management provide you with? You asked for the logbook. Okay. Now you're going to be reviewing all the evidence, for example, you did obtain on, for example, the rights and obligation on that motor vehicle. So you're going to be, like, what is the best word to use? Okay, you're going to be trying to correspond or collaborate, okay, all the evidence you obtain on all the different accounts, trying to see, okay, the assertion on the rights and obligation, is it true, okay, the assertion on accuracy, is it true on the case of the cash? Okay, so you're going to be trying to have an overall review of the audit evidence you've been obtaining throughout the entire audit process. Okay. The other thing you may want to is called the uncorrected misstatement. Okay. So generally, don't forget, if, for example, you do discover misstatement, okay, if you do discover misstatement along the way, for example, maybe the sales were overstated, what do? You inform the management, hey, your sales figures are overstated by X amount, okay? So don't forget, the management are meant to make an adjustment, okay? So definitely if that's the right thing to be done, okay, they need to do the adjustment, okay? As an auditor, you do keep a schedule of the misstatement you found along the way, okay? And of course, at the end of you may be taking, okay, this is the mistake found, okay? Let me just share my board here, okay? Okay, for example, assume that you're auditing the sales, okay? You audit the sales, okay? You do record that here there's a misstatement I've just found on sales, okay? The misstatement found here on sale. The sales have been understated, okay, by let's say 10 million, okay, by 10 million, okay. So you can record it, okay. That's Mr. 1. Then Mr. 2 on inventory, they have been overstated by let's say 2 million, okay. So you have a schedule of all the misstatement you have found along the way, okay. But of course here you may have, has the management done has the management adjusted the accounts, okay. You can have yes or no, this example, okay. So yes, okay, no, not yet, okay. So you have a sort of a schedule, okay. So at the end of the day, okay, at the end of the audit, okay, you have that schedule of all the misstatement, okay, you may have found along the way, along the audit, okay. So you have that schedule, okay, the one that have been corrected, okay, and the one that has not been corrected by the management, okay. So don't forget, at the end you're going to be combining, okay. So this misstatement, individually, I think you mentioned, they might be immaterial. Okay. However, once combined with other misstatements, they may become material. So in this case, therefore, in the audit finalization, have that schedule. Okay, trying to say what are the misstatements that have not yet been corrected. Are they material? Okay, what should I do as an auditor? Okay, should I go ahead and maybe tell the management, no, you cannot go ahead with all of, I will give or I will qualify your accounts because I did ask you to make an adjustment in this particular area. You never did it. Okay, and of course the misstatements, okay, combined with all the other misstatements you have not corrected are material, and therefore I may end up maybe stating that your accounts do not present a true and a fair view. Okay. Wow. My screen is still blurred. No, I don't know what I can do now. I've tried to adjust to the maximum I can be able to do now. Hey, let me see. No, actually, I want to. I don't know. I hear that in case you're using phone, that you must have it might bring issues. But let me just check, confirm from you. Ashley.
Yes.
No, how is my screen? Because I'm wondering now what to do.
Okay, right now it's clear. Then it comes to a point when it becomes blurred. So I don't know.
Oh, it's okay.
Blood clear, yeah.
Okay, my guess could be that maybe it's more towards the network connection or the internet connection. That's my guess. That's my guess.
Okay, let's say so. Okay.
Okay. Okay, so you maintain a schedule of the uncorrected misstatement. Okay, so you maintain one. Okay, so for now, okay, we will not discuss more in detail. Okay, regarding this schedule. Okay, shall not discuss more in detail. Anyway, so this one you shall discuss more in the advanced audit and assurance. Our main concern actually is more towards what we call the subsequent event, okay, and the going concern and the written representation, okay. That is our main concern, okay. What we call the events after the reporting period, okay, the going concern review, and what referred to as written representations, okay. Now, this one on the subsequent event, you have already discussed it. Yes, you did this in financial management. Okay, let me check whether it's still not financial management, on financial reporting. You did events after reporting period. Delphine. Yes. Delphine, yes. You did the events after the reporting period. Yes. Delphine, you're there?
Yes.
Yes.
You're asking which IS?
Yes. Sorry?
10.
IS-10. Don't forget you did this in IS-10. Okay, you did discuss the events after the reporting period at IS-10. So we shall be referring to what you discussed then. Okay, at IS-10. Okay, so of course, as an auditor, you shall be reviewing those. Okay, this is more towards now the side of the auditor. Okay, on the audit on the events of the reporting period. Okay, how do we review them as auditors? Okay. Then going concern, of course, okay, going concern, I think you did discuss, okay, in the first account paper you did, okay, you did say that you meant to prepare the accounts of the company on the going concern basis, okay, that the company is going to be in operation in the foreseeable future, okay, the company will be in operation in the foreseeable future, okay. if the company will not be in operation in the foreseeable future, what accounting basis, therefore, do you use to prepare the accounts of the company? If the company will be in operation in the foreseeable future, okay, we said to use the going concern. Therefore, if the company will not be in operation in the foreseeable future, what accounting basis to use? Let me check. Samuel.
Yes.
Yes. If the company will not be, is not a going concern, okay? So the company, for example, is going to close down in the next 3 months, okay? What accounting basis do you use?
I don't.
You're not sure?
I'm not sure.
Okay, let me check someone else here. Quinta.
I've forgotten.
You've forgotten. Okay, no worry. Kami. It's Kami.
Yeah.
Kami, what accounting
I'm
basis
not
do you
sure.
use? You're not sure?
Yeah.
Wow, okay. Jeffrey. It's Jeffrey. Jeff?
Yes.
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 What accounting basis do you use? You got the question?
No.
Oh, the question was, okay, if the company, okay, is not a going concern, okay, hey, let me mute some people. So back to you, Jeff. So if the company is not a going concern, you sure the company will close down in the next maybe 6 months, or the management has no intention, or the management has the intention of closing down the company's operation. What accounting basis do we use therefore? Because you cannot use going concern basis in preparing the accounts of the company.
I'm not sure. I'm not sure.
You're not sure? Okay, let me check. David. David? David?
Yes.
Yes.
Yes. Yes.
Yes. What the basis do you use?
I'm not sure as well.
You're not sure as well? Okay, let me check. Petronila. Yes,
Yes.
Petronila. Okay, Petronila.
Yeah.
Yes.
I don't know too. I'm confused.
You're not.
I have no idea.
You have no
I'm
idea.
not sure.
Okay. Now, who knows now? Where's Emma? Yes, Emma.
I'm not sure, but do you prepare them on a winding up basis?
It's called the liquidation basis or the winding up basis. Yes, you prepare them on the liquidation basis, or sometimes referred to as the winding up basis. Okay, this one is called as the liquidation basis. Okay, so you prepare the accounts of the company, assuming the company is going to close down. Okay, so if, for example, you're preparing on the assets of the company, okay, you prepare them not on what if, for example, it's about the inventory, okay, you don't prepare them based on the cost, okay, you prepare them based on how much can I be able to receive if I was to sell off my inventory, okay, how much should I be receiving if I was to sell off my inventory, okay, so you prepare them based on what can this particular asset fetch in the market, okay, not on the basis of cost, okay, not on the case of the NBV, no, you're going to assume that the company is closing down. So how much can we fetch from the sale of this particular asset in the market as it is? So you're going to prepare therefore on the liquidation basis, okay? Next, you have got the written representations, okay? In some cases, okay, as you gather the evidence, as you do gather the evidence, okay, there's some areas or some scenarios where you can't obtain the evidence, okay, or it's hard for you as a auditor, okay, to obtain that evidence, okay. The only person who can provide you with that evidence is the management. okay, is all referred to as the management, okay. And actually sometimes it's referred to as the management written representations, okay. For example, on a going concern, okay, you do want to know, okay, one of the things you need to know, okay, you need to question, okay, regarding during the going concern review is the intention of the management regarding the company chance of it being in operation in the next 12 months. Now, where can you obtain that evidence? You have to inquire from the management. You have to go to the management, ask them, does the management has any intention of closing down in the next 12 months? So the evidence will only come from the management, okay? If, for example, is on the case of capitalization, okay, I think we did discuss, okay, should we capitalize, should we expense, maybe R&D, okay. One of the key criteria is a management going to, for example, provide the necessary support, okay. You want to assess, you want to obtain that, in quote, the confidence from the management that they are willing and ready to ensure that they do give all the support necessary towards the completion of the project, towards the research, okay. Now, who is going to give that evidence? You have to inquire, you have to obtain this evidence from the management, okay? So things about the management intentions, who do you ask? It has to come from the management, okay? They have to come from management, okay? So that evidence, no one else is going to give you, okay? So you need to obtain what called written representations, okay? So as an auditor, you do prepare a letter addressed to the management, okay? You do prepare a letter addressed to the management, okay? Inquiring on some matters. One of them can be the management intention to close down the company, okay? Another thing could be, for example, on the where the management is committed, okay, to see through this particular project, okay? This particular research, okay? So you're going to write a letter as an auditor, then you wait, in quote, for the response from the management. The response you're going to be receiving is what referred to as the written representation, okay? And of course, you'll be discussing this on things that, on matters that essentially you cannot, or it is the management who are going to provide you solely with that evidence, okay? Referred to as the management written representations, okay? That's what, therefore, we shall be discussing. These are the very core things that we shall be discussing going forward, okay? These are 3 things that we shall be discussing. As mentioned, don't forget, our key concentration now here is on the overall review of financial statement. And don't forget, we began all the way to understanding the entry. This way, don't forget this. This is where we were, okay? This is where we were discussing, okay? All the way from studying the entry, okay? We have gone all the way until we are now at this particular point, okay? Don't forget, this is your syllabus, okay? So don't forget these sort of diagrammatic representation of the audit process, okay, in itself is actually how we do the audit, okay, all the way from understanding the entry to the time that you're going to give final opinion. Don't forget, you're going to end the audit. We are going to end the audit process once we report the members with the opinion, okay. That is when the audit process is going to come to an end, okay. Once we report the members on how, or the opinion, okay, on the set of accounts that we have prepared. Okay, on the set of account that you have gone through, we have examined, not prepared, we have examined, okay? So as I mentioned from our first class, audit is a process, okay? The beginning and with an end, okay? So we are almost close, therefore, to the end, okay? Reporting to the members, now we are reviewing what we call audit finalization and the review, okay? As mentioned, okay? You're going to be, okay, or one of the final audit process we need to carry out is the subsequent events, okay. That is the events after the reporting period, the events after the reporting period, okay. And generally, okay, if you do remember at the IS-10, okay, at the IS-10, so okay, we're going to be using IS-10 and we're going to use the International Accounting Standard number 10 and the ISA 560, okay? So those are the 2 standards we shall be using in collaboration, okay? Those are 2 ISAs we shall be using, okay? In IS-10, you need to say that essentially, okay, when it comes to the events after the reporting period, okay, we classify them in 2 main categories, okay? We are called the adjusting events, and we have the so-called the non-adjusting events, okay? Adjusting and non-adjusting events, okay? And what are subsequent events? Okay, so all those events. Okay, let me just how we draw. Okay. If, for example, okay, the year starts on 1st of January 2020, it ends on that 1st of December 2020. Okay, this is the start of the year. This is the financial year end. Okay, year end of the year. Then here it's the time you give your audit report. Okay, audit report. Then here, let's see, you give the audit report on 28th of February 2021. Then the company has its AGM. Let's see, on that 1st of March. That 1st March, okay, 2021. Okay. Now all the events, okay, all the events that will occur between the end of the year, between that 1st of December, all the time you give your audit report, all the events that occur here, okay, this is called the subsequent event. Okay, that's referred to as the subsequent events. Okay, the subsequent events. Okay, the events that are going to occur after the year end. Okay, they may extend. Okay, even the period after you give your opinion, but essentially this is the common. This is what referred to as the subsequent event. Okay, between the time that the year has come to an end. Okay, and the time that you as an auditor you're going to give your final audit report. In short, the opinion. Okay. So the events occur there. For example, the sale that is made. Okay, whatever it is. Okay. So the events that occur between that 1st of January, okay, all the way to the 28th of February is what we're going to find for us the subsequent events. Okay, the subsequent events. Okay. Then, as I mentioned, there are two. Okay, we can classify the subsequent event into main category. Okay, we have called the adjusting event and here we call the non-adjusting event. Okay, adjusting and non-adjusting event. Okay, now if this event, okay, or this, okay, information, let me call it information, okay, that is between that 1st of December and 28th of February, okay, the subsequent event, okay, is going to give us information, is going to give us more information regarding the status of, okay, of some matter, okay, that occurred before the year end. Okay, it is going to give us information, okay, regarding the status of maybe, I don't know, let's say inventory, the company, the current asset, whatever it is, okay. However, it is going to give us more information of something that was in existence before that 1st of December, okay, in existence before that 1st of December, then that's going to call the adjusting event, okay. It is giving us, let me just give an example. Assume that on 10th of January, okay, assume that on 10th of January 2021, the company make a sale of inventory, okay, the company make a sale of inventory. This inventory did exist, okay, assume they were bought on, let's say, on 10th of December, okay. The sale that was made on 10th of January, okay, was bought, or those inventory were bought in the previous year, okay, on the 10th of December, okay. So the sale that has just occurred, okay, is giving us information of the inventory that did exist before the year end. Okay. Now that sale, okay, that information, okay, therefore we classify this as adjusting event. Okay, we classify it as adjusting event. Okay, we classify it as adjusting event. Okay. Now, essentially, if an event is going to occur, okay, let's say on the 10th of January, okay, 2021. However, it does not give us information of status that was there as at that 1st of December, then we classify it as a non-adjusting event. Okay? It is not giving us more information regarding the status of some things at the close of the year. Okay, we refer to it as simply as the non-adjusting events. Okay, hope that's clear. Okay. The subsequent events, okay, as I mentioned, they can go beyond the audit report, okay, but of your key concern, okay, where you do have a responsibility as an auditor is between that 1st December, of course, all the way from 1st January, okay, all the way to the 28th of 1st of January 2020, okay, the start of the audit, until you give your audit report. That's where you are responsible, okay, you have a legal responsibility, okay. after you give a report, essentially, you do not have legal responsibility. Okay. Even though, as I mentioned, the subsequent events can go beyond the point when you do give your final audit reports. Okay. So that's on the audit subsequent events. Okay. And I guess we can end the class there. Then tomorrow we pick from that point. Clear? Question? Okay, so in case there's no question, then I guess we can meet tomorrow. Okay, see you tomorrow.